It's a great opportunity for you on that week of holiday week. Take a look at the market, how it slowly and methodically trends. Now, this is a stair-step pattern. The stair-step pattern is something that looks like this. Here, let me go into the future. You think of a staircase, and you think of a staircase that looks like this. Now, in trading, after the fact, we can all look at this and say, oh yeah, I see it. But you have to realize that it's occurring while it's actually developing, not after the fact, because it's over after the fact. Think of a staircase. The last week of the year typically has a pump or a push or some type of a breakout, and then a pause, and then another breakout, very slow, mind you, it's very slow, and then a pause, and then another breakout and a pause. You'll see this the entire week. It's slow, but you'll see this action the entire week of the year. Okay? Yeah, Dean, what I was showing you earlier was a 60-minute chart with the 4 bars or 4 or 5 candles retracing, testing the new highs for the day, for that day. So even though it may not be all-time highs, the last month of the year typically pushes higher and higher. We're going to focus more on longs, and we're going to look at for the day making new highs, retracing 4 or 5 hours, 4 or 5 half hours, and then as it reverts back up, put on that 50% tool, this tool right here, like this, and once it breaks the midpoint by a point, let's say a couple ticks, now you're going with the momentum back up. You don't have to make the highest high the target. Just take 1 times the ATR in between where you enter, leading you up. Being conservative, it doesn't really hurt you, because if it touches your target or if it just misses it by a tick and you don't get filled, that's no help to anyone. You means you were almost right, but still not a successful trade. So think about it leading you up to the highs and getting out before it even tags the double top or tags the highs for the day, that is, Dean. Okay? You okay with that? So that's what I was showing you earlier on the 60-minute chart. But this here, what I'm showing you, the last week of the year, as the market comes to an end, it's very common for a slow, methodical trend up, which is very difficult to understand as it's happening. Think of this stair step or this staircase. And the staircase, even for today, it's not really the ideal stair step or staircase element of price action. But think of this day here as the end of the year. Okay, you have the market moving higher, stopping, moving a little bit higher, and then stopping, and then moving a little bit higher and stopping. After the fact, everything is so clear. You say to yourself, I don't understand why I didn't see it. Think of the pivots that the market is creating as a stop. If you are concerned about losing money, as everybody should be, trading is not for everyone, so please be very careful. The slow environment allows you to take smaller losses because the market moves so slow, but think of each pivot as a stop, let's say. Now, I like to use what's called a pivotal stop. In most of the things that I teach, it's not just one stop. It's a variety of exit strategies, whichever happens first. Time, pivotal stop, catastrophic stop, prove it stop. So 2 ticks below this pivot, I would say better to have your stop here than to have it right on that lowest low. Give it a little bit more breathing room. 2 ticks is not going to make or break you. As far as if you lose money, it's just 2 ticks. You already lost, so give it a little bit more breathing room. Markets love to test where they've been, remember? So if the market comes down to test this, you're not stopped out. Let it go 2 ticks beyond that pivot. Pivotal stop is what I call it. The same thing if the market goes higher, use the next element for your pivotal stop, let's say here. 2 ticks below, 1, 2, that's where you would say, if it goes and reverses, I'm protected, I'm out. The same thing, if it goes up, stops, you have your pivotal stop. If it makes new highs, use this, minus 2 ticks, pivotal stop. Now you can use this, minus 2 ticks, pivotal stop. So the last week of the year, you may think that it's not worth trading. I think it's slow. The way you have to approach it is a little bit differently than just scalping or just putting on indicators when it's so slow. It's a different environment completely. All right, Dean's good. All right, Vlad says here, are those steps an Atlas line pullback trade? These are, so some of them are, at least. We have to make sure that they conform to the rules, right? So these would be considered a stair-step pattern for the Atlas line, right? Right here to go long. As long as it, or strength trades too. Let me see here. Right, strength and pullback trades like that. So the market, when it's slow, it typically chops around, very difficult to trade. But the last week of the year, it's almost always trending. So take advantage of it. Not that you have to hold on overnight because the margin is more, but at least for that day, you can realize the outcome. Take a couple of points and then stop. You got it, Vlad. All right. Vlad just finished up mentorship with me, and he's out in Hawaii. And if you want to say anything, Vlad, feel free. Let everybody know what you thought about the program. I don't want to put you on a spot there. Just a little bit, right? Okay, one last thing here that we are going to cover in this webinar. Last month of the year, typically bullish, makes new highs, it retraces, 4 or 5 candles, hourly chart is what I showed you, heads back up, you have an opportunity. But when you look at the day before Christmas and the day before New Year's, those are days that you should not be trading. So in the event that you want to trade right up until the 24th, I'm not even sure if that's a weekend or holiday or not, but the Friday before, or if it's the day before, I definitely recommend just staying out, only because it's a day that is not really a normal type of trading day, just like the day before Thanksgiving, the day before Memorial Day, the day before 3-day weekends. A lot of people who are trading the markets are not in the market, so it's a different element, so the market behaves differently. It's very easily pushed. Thanks, Vlad. I'm just going to push that. And Brian, too, right? Brian as well. Mentorship student. Okay, take a look at some scalping. Scalping is something that I get a lot of emails on. Everybody wants to scalp. I said to you here earlier that the first 10 minutes of the day is difficult because of this high volatile bear and bull fight. But you forget that there's 3 elements to the day. There's the morning part of the day here, where I consider this the A part of the day. For you guys who know the ABC, the A part of the day. A lot of action, my favorite part of the day. For scalping, it's typically the best, just not the first 5 and 10 minutes of the day because of that battle. Now the middle part of the day, the B part of the day here, is not too bad for scalping, but the element is completely different. The B part of the day, in my opinion, is important because it either makes the day normal or makes the day a trending day or not normal, or a day that's more volatile than it should be. When you look at this ATR down here, it typically starts out high and goes lower and lower and lower. So if you're trying to scalp in this B part of the day, the activity is not the same. The market is slower, and I can see that because the ATR is also slower. And Look, as an example, if I add the ABC indicator here, you can see the A part of the day, the B part of the day, and the C part of the day, just like I was doing it manually here. Look at the ATR, the corresponding average true range, which really demonstrates the type of market that is underway. Market starts off nice and healthy and volatile, and then starts getting slower and slower and slower. If you're scalping in this, what I call the B part of the day here, you have to realize that the 3-tick target may not be achievable. It may just be 2 ticks. So when you look at taking a scalp trade, it could be 4 ticks, it could be 3 ticks, it could be 2 ticks, but it's not the same throughout the day. It's different. Now, for scalping, I use either a tick chart or I use a 1-minute chart. So I'm just going to go here to a 1-minute chart. And as I go forward here, the ATR is about 1 tick, 2 ticks. Here's my recommendation. When the market is less than half a point or 2 ticks on whatever market you're looking at, it's really not worth the risk. You're not going to trade for a tick unless you're trading 100 contracts, which I think no one should be doing. But to trade for a tick and to have that risk of loss for a tick of profit, that risk to reward ratio does not make sense. 2 ticks, think of the market as slow but tradable. 3 ticks, much better. So for everyone out there who's new to price action or new to the type of trading that I do, look at some ATR videos that I've put out there. Look at the 2-tick area, whatever market happens to be in, place a horizontal line, place another horizontal line at 3 ticks right here, and then say to yourself, if I'm going to scalp, if I'm going to take a trade, looking at a 1-minute chart, 3 ticks, it's achievable. 2 ticks now is achievable, but not 3 because the market is slower. When we reach here and you have an opportunity, skip it. It's 1 tick. I wouldn't trade for a tick. Here again, if you have an opportunity, it's 1 tick. Don't trade for a tick. Now the C part of the day, which is this here, the C part of the day happens to be a different element entirely. It's probably closer aligned to the B, but it's different because we have late day rallies and late day sell-offs, and we also have what a lot of people don't know about is a squeeze as we get into the end of the day. So a squeeze occurs when traders are getting out of their positions. They're day traders. They trade on margin. It's the same across all markets. It doesn't matter. And as the session comes to an end, they get squeezed and they start pulling their positions and closing them out at market, and you have this increase in volatility. You can look at the time and sales window. You can take a look at a number of things. Don't trade. Really what this comes down to is scalping within the last 15 minutes of the session, whether it be the US session or the London session, whatever session, Asian session. You're going to notice that there's an increased volatility as the session comes to an end because they're squeezing the day traders into forcing them to get out due to margin. They don't have enough margin to hold trades overnight. They're forced to get out. And that's what you see almost every single day at the end of the US session, which for me happens to be about 4:15. So 20 minutes prior to 4:15 Eastern Standard, you can start to see, which is outlined right here. They're squeezing them out. They're just pulling their contracts out of the market in order to start again fresh tomorrow. So this is very normal. So I don't want to get stuck, especially with small stops and scalping and trading towards the end of the day. You're going to get squeezed as well. Is there a way to take advantage of that? Jerry, I don't recommend it because if you take a look at the dome, if you put up a dome, and you can do this yourself, when you take a look at the dome towards the end of the day, you're going to see this start to really move, meaning it'll jump, it'll go up, then down. These are unpredictable movements because everybody's getting out at market. It's the same way when the news event pops, everyone just jumps in at market. Buyers and sellers are just exiting at random, very random. But that's a very good question, though, Jerry. How would you take advantage of that? I would say that's a tough call to make. I rather look at the opportunities when things are a little bit more systematic, where I can realize the conditions are right, the setups are right, the stops are right, they're not too big, not too small, the market's not overbought, oversold, I'm getting in at a better price. All those things help you as a trader, but this unpredictability is what really hurts. All right, let's take a look. Let me remove here the ABC indicator, and let's take a look at some scalping trades. I know you guys are asking about the trade scalper signals, and let me actually remove the indicator, and I'll leave the ATR. I like this ATR in any type of trading that I do except for the tick chart, and we'll add the trade scalper. Okay, so look at the signals that the trade scalper produced today. This is the 6th. Now these signals occur when the market makes a move, either with a pop of some sort of breakout or with what I call a 2-wick model. It's a way of looking at the price wanting to go higher or wanting to go lower with the indication of only the wicks, not closing prices or not new highs. It's just the wicks that I'm making the reference to. So if you take a look here at these trades, there's a few things, and by all means, it's not that I want to just scalp all day long, but you do have opportunities when there's a trend. Or if you look at only trading the first part of the day, there's a few hours that the market is highly volatile. That's the way to go. Again, put a horizontal line here at 2 ticks and at 3 ticks. And at this moment, any trade that you take should only be for 2 ticks, a 2-tick target. Any trade that you take. In comparison, the trades here, so you see as soon as the session opens how they're more volatile. Any trade that you take should be 3 ticks. So in my opinion, the opportunities are not only buy and sell, but know the distance the market can give you. And it's not something that we should guess, it's just something that we should say, yes, 2 ticks is possible, or no, it's not possible. The same thing with here. So there's a situation where there's a signal to go short here. This is already telling me, if I look at the market, that the 1 tick marker is where we're at. Don't trade for a tick. Wait for the next signal to only allow 2 ticks minimum, 3 ticks or more better on this ATR, because you can't trade under these slower conditions. They'll just chop around on you. The same thing here with this short. It's less than a tick. You can't trade for a tick. So all these signals that correspond to this, you don't take. You skip them. Now what you're seeing here is the demo version of the trade scalper. The version that you actually get is much more refined because it includes a few additional aspects. So for example, you can turn on or turn off the first trade. You can show the double wick, yes or no. You can show the text. You have a sound file. And here is where I think this helps. This filter, it dictates whether or not you see a signal. So if you don't want to see a signal at anything less than a tick or 2, you say, I don't want to see a signal when the market is less than 2 ticks or 3 ticks. So this filter allows you to alleviate seeing any signal based on whatever you say. It has to be minimal on the volatility or the ATR. And so it's using the ATR to say it's got to be above 2 ticks or not. And you can use whatever value you want in any market. Colors, everything can be changed according to your preference as well. So this is the actual software. What you're seeing here are just signals. It's not the actual software that you receive. Let's take a look at a day where the market is a little bit more um, volatile here. Okay, so all these signals here overnight, lots of chop. I wouldn't touch that. A lot of chop, just chop, chop, chop. But if you know that the better opportunities are above 3 ticks, 2 ticks, this is where you want to trade. So I'm going to expand this out here to so you can see. Long. Remember, the first 5-10 minutes I think are risky, right? Because of this up and down battle. The first thing I mentioned in this webinar. So here you have a buy. Here you have another buy. Actually, there's two different signals setting up, the double wick and the regular long. There's a triangle, obviously, that shows you the price that you're supposed to be long at. Here's a short, and this short looks like a losing trade. So this is a losing trade here. This is a long at this price. And there's another long here. Short, short. Now, take a look at this here. 2 ticks is what you can expect. What did the market do? From here to here, 2 ticks. You have an expectation of what the market can do. Now, you got to be careful. This may not fill you. If it just touches and it doesn't fill you, I want you to exit the trade at break even. I don't want you to hold on to a losing trade. But the expectation that it could make 2 ticks, just like it's saying that it's capable of doing, exists. If it was less, if it was just 1 tick, forget it. Wouldn't do that. Wouldn't want to take it. So there's a little bit more here to the trade scalper. It incorporates price action, stops, time, breakouts. Just remember, last 15-20 minutes, it's dangerous. The first 5 minutes, first 5-10 minutes of the session, it's also very dangerous. Okay? I know some of you are already signed up for December, so I look forward to seeing you guys for the December 15th mentorship. And have a great rest of your week, and I'll talk to you soon. Thanks, Vlad. You got it, everybody. Email me if you have any questions after reviewing this. Bye-bye now. Thanks, Hans.